If the value of money itself starts to shift, what actually stays valuable? That's not a theoretical question. It's a practical one that serious investors think about long before anything shows up in headlines. Because when the system changes, it's already too late to start learning. Take a second to like this video and subscribe. Not because you need more content, but because understanding how value moves in uncertain environments is one of the most useful financial skills you can build. Now let's get clear on something most people misunderstand. A currency is not wealth. It's a tool that measures wealth. And like any measuring tool, it can change. When a currency loses purchasing power, or when global monetary systems evolve, the underlying assets don't disappear. What changes is how they're priced, how they're trusted, and how they behave relative to each other. This is why the idea of a currency reset is often misinterpreted. People imagine a sudden breakdown, but historically, what actually happens is more gradual. Purchasing power shifts, confidence adjusts, capital begins to move differently, and that movement is where the real story is, because wealth doesn't vanish during these periods, it transfers. It transfers into assets that the market continues to trust. Now here's where most investors make a mistake. They look for a single answer, a single asset that will protect everything. But real financial systems are more complex than that. Different assets respond differently depending on what exactly is changing. Interest rates, inflation expectations, liquidity conditions, or global trade dynamics. So instead of looking for one perfect asset, you need to understand the characteristics that allow certain assets to hold value across changing conditions. Think about it like this. If the measuring stick changes, you want to own things that are not dependent on the measuring stick staying the same. Assets tied purely to currency stability behave one way. Assets tied to real-world demand behave another, and assets with global acceptance behave differently again. That distinction matters, because during periods of transition, pricing becomes less about what worked in the past and more about what continues to function in the present. And this is where a more strategic mindset begins. Instead of asking, "What should I buy right now?" you start asking, "What continues to hold relevance if the system shifts?" That one shift in thinking separates reactive investors from prepared ones. Because when the environment changes, the goal isn't to guess perfectly. It's to already be positioned in things that don't rely on a single outcome. To figure out which assets hold value during a currency reset, you have to understand what actually changes first when a monetary system begins to shift. It's not the assets themselves, it's the assumptions behind how they are valued. In stable environments, investors rely on consistency. Interest rates behave within expected ranges. Inflation is relatively predictable. Currency strength doesn't swing dramatically. That stability allows assets, especially financial ones, to be priced with confidence. But when a currency starts losing purchasing power, or when global systems begin to diversify, those assumptions become less reliable. And when assumptions weaken, pricing becomes more sensitive. This is where the concept of store of value becomes more practical than theoretical. A store of value is not something that never fluctuates. It's something that maintains purchasing power over time, even if the currency measuring it is changing. Now here's the nuance. Different assets preserve value in different ways. Some preserve value because they are scarce, some because they are productive, some because they are widely accepted across different systems. Understanding those differences is what gives you an edge. Let's start with financial assets. These include things like bonds, savings instruments, and even many equities. They can perform extremely well when the monetary system is stable because they rely on predictable discount rates and policy environments. But during transitions, they can become more sensitive. If inflation expectations rise or interest rates become less predictable, the value of future cash flows becomes harder to estimate. That doesn't make them bad assets. It just means their behavior changes. Now compare that to real assets. Real assets, like land, infrastructure, or commodities, derive value from their physical usefulness. They are not just financial claims. They represent something tangible that people need or use. Because of that, They often respond differently when currencies shift. If purchasing power declines, the price of these assets may adjust to reflect that change. Again, not perfectly, not instantly, but structurally, they are less dependent on a stable currency framework. Then, there's a third category that often gets overlooked: assets with global demand. These are assets that are not tied to a single country's economic conditions. Their value is influenced by multiple systems at once, which can make them behave differently during localized currency changes. The key takeaway is this: no asset is immune to change, but some are less dependent on the stability of a single currency than others. And during a currency reset, or even a gradual monetary shift, that difference becomes more important than most people expect. Once you understand that different assets respond differently to changing monetary conditions, the next step is recognizing what actually gives an asset staying power when currencies begin to shift. Because it's not about labels like safe or risky, it's about underlying characteristics. The first characteristic is scarcity. Scarcity matters because it limits supply regardless of what happens to a currency. If something cannot be easily created or expanded, its value tends to be anchored in that constraint rather than in the currency used to price it. This is why certain assets have historically maintained relevance across different monetary systems. Their supply is not controlled by policy decisions in the same way that currencies are. But scarcity alone is not enough. The second characteristic is utility. An asset that is useful, meaning it serves a real economic purpose, has a built-in layer of demand. People need it, use it, or rely on it in production or daily life. That demand doesn't disappear just because a currency changes, and when demand remains stable while the measuring system shifts, pricing adjusts accordingly. Now here's where things get more interesting. The third characteristic is global acceptance. An asset that is recognized and valued across multiple regions has a broader base of demand. It is not dependent on one country's policy environment or one currency system. That broader demand base can make it more resilient when local conditions change. But there's another layer most people overlook: liquidity. Liquidity is the ability to convert an asset into purchasing power quickly and with minimal friction. During stable periods, liquidity feels easy. But during transitions, liquidity becomes more selective. Some assets remain highly liquid across different conditions. Others become harder to trade efficiently, especially if market confidence temporarily weakens. And this is where real-world behavior starts to diverge from theory. An asset might be valuable in principle, but if it cannot be accessed or converted easily when needed, its practical value becomes limited in the short term. That's why experienced investors don't just look at what an asset is, they look at how it behaves under different conditions. Does it maintain demand? Does it remain tradable? Does it depend heavily on a single system staying stable? Because during a currency shift, those questions become more important than past performance. Now here's the key insight. Assets that combine scarcity, utility, global demand, and reasonable liquidity tend to maintain relevance across different monetary environments. Not perfectly, not without volatility, but structurally. And once you start evaluating assets through that lens, you stop focusing on short-term price movements and start focusing on long-term resilience. Because in the end, value is not about what something is worth today. It's about whether it continues to be valued tomorrow, regardless of how the system around it evolves. Now that you understand the core characteristics that help assets retain value, the next step is seeing how these characteristics actually play out in real market conditions when currencies begin to shift. Because theory is useful, but behavior is what matters. During a monetary transition, one of the first things that changes is how assets relate to each other. Relationships that felt stable for years can begin to weaken. Assets that once moved together start moving differently, and this creates a sense that the market is becoming unpredictable. In reality, it's not becoming unpredictable, it's becoming restructured, and restructuring creates both confusion and opportunity. For example, in a stable environment, many financial assets are priced based on expectations about interest rates, inflation, and economic growth. When those expectations are clear, valuation models work smoothly. But when a currency begins to lose purchasing power or when monetary policy becomes less predictable, those same models start to lose precision. And when precision drops, volatility increases. Now here's where the distinction becomes important. Volatility is not the same as loss of value. It simply means the market is trying to find a new equilibrium. And during that process, assets that are heavily dependent on stable assumptions tend to fluctuate more. Meanwhile, assets tied to real-world demand or scarcity may begin to reflect underlying economic realities more directly. But even that is not always straightforward, because liquidity plays a major role in how assets behave during transitions. When liquidity is strong, capital moves freely and pricing adjusts gradually. But when liquidity tightens, even temporarily, price movements can become sharper, not because the asset has fundamentally changed, but because fewer participants are able or willing to transact. This is why some assets can appear unstable in the short term, even if their long-term value proposition remains intact. Now think about what this means from a strategic perspective. If you only focus on price movement, you may misinterpret what is actually happening. You might see volatility and assume weakness, when in reality, the asset is simply adjusting to a new monetary context. This is why experienced investors focus on behavior under stress, rather than behavior in ideal conditions. They observe how assets respond when assumptions are challenged. Do they maintain demand? Do they remain functional within the system? Do they continue to attract capital even when conditions are less predictable? Because those are the signals that matter during a currency shift. And once you begin to interpret markets through that lens, you stop reacting to noise and start understanding structure. You start seeing not just what is happening, but why it is happening. And that clarity is what allows you to make more consistent decisions, even when the environment itself is changing. At this point, the conversation shifts from understanding asset behavior to understanding investor behavior, because during any currency transition, the biggest driver of outcomes is not just economics, but psychology. When uncertainty enters the system, people don't respond logically first. They respond emotionally first and rationalize later. That pattern shows up in every major financial cycle in history. And it's important to recognize this clearly, not to judge it, but to understand how it impacts pricing. When confidence in a currency weakens, even slightly, investors begin to reassess what they trust. That reassessment does not happen evenly. It happens in waves. Some participants move early based on expectations, others wait for confirmation, and others react only after changes are obvious. This staggered behavior creates shifting demand across different asset classes. Now here's the key point. Assets that hold value during these transitions are not necessarily those that are perfect in any one metric. They are often the ones that remain consistently trusted across different types of uncertainty. Trust is the real foundation of value in financial systems. Not narrative, not hype, not short-term performance, trust. And trust is built through repetition of use, historical reliability, and broad acceptance across market participants. That's why certain assets tend to remain relevant even when conditions are unstable. Not because they are immune to change, but because participants continue to believe they will be accepted by others in the future. This is also where liquidity behavior becomes especially important again. In uncertain environments, capital tends to concentrate. It flows toward assets that are easiest to enter and exit without major friction. That doesn't always mean those assets are the most fundamentally strong. It means they are the most accessible under stress. And accessibility becomes a form of safety in itself. Now consider how this affects pricing dynamics. When many participants move toward the same categories of assets, demand increases and prices adjust accordingly. At the same time, assets perceived as less liquid or more uncertain may experience reduced participation, even if their long-term fundamentals haven't changed. This divergence between perception and fundamentals is where opportunities and mistakes both emerge. Because investors who confuse temporary behavior with permanent value shifts often make reactive decisions. Meanwhile, those who understand the difference between sentiment-driven movement and structural change are able to stay more grounded. And that grounding is crucial, because during a currency shift, the real challenge is not just identifying what might hold value, it's avoiding the impulse to overreact to short-term noise. The investors who navigate these periods effectively are not the ones who predict every move correctly. They are the ones who maintain a consistent framework for evaluating value, even when others are abandoning theirs. And that consistency becomes an advantage when the system itself is in motion. So let's bring everything together in a practical way. If currencies are measuring tools, and those tools can change over time, then the real question is never what will happen next, but what continues to function regardless of what changes. That is the core of wealth preservation thinking. Because in any monetary shift, whether gradual or significant, assets don't all move in the same direction or at the same speed. They respond based on their structure, their demand base, and how deeply they are tied to a specific financial system. Now step back and think in terms of categories rather than predictions. Some assets are highly dependent on stable monetary policy and predictable interest rates. These can perform extremely well in calm environments, but they tend to be more sensitive when assumptions change. Some assets are tied to physical or real-world utility. Their value is rooted in function, demand, and necessity. These often behave differently because their usefulness does not disappear when currency conditions shift. And some assets operate on a global scale, with demand distributed across multiple systems. Their valuation is influenced by broader participation rather than a single monetary environment. The important insight is not choosing one category over another. It's understanding how they interact. Because in reality, financial resilience is rarely built from a single asset. It comes from understanding balance, how different types of value behave under different conditions. Now here's something most people overlook. A currency reset, in the way it is often discussed, is not usually a sudden event where everything changes overnight. It is more commonly a process where confidence, policy, and global alignment shift over time. And during that process, capital doesn't disappear. It reallocates. It moves toward assets that maintain acceptance, usefulness, and trust across changing conditions. This is why long-term investors focus less on reacting to headlines and more on understanding structure. They ask questions like, what remains useful in multiple environments? What continues to be accepted across different systems? What retains demand even when conditions are uncertain? Those questions don't produce perfect predictions, but they do produce better positioning. And positioning is what matters most when the environment itself is evolving. Because once you accept that change is a constant in financial systems, your goal is no longer to avoid it. Your goal becomes to understand it well enough to move with it rather than against it. And that is where real financial confidence comes from. Not from certainty, but from clarity about how value actually behaves when the rules begin to shift.